Hello and welcome back to my series on personal finance and asset management. We've been going up the ladder of risk management, and today we're going to take a look at the idea of real estate as an asset class. Okay, so if we just come back here to the whiteboard, quick reminder, right? Here we are looking at insurance, okay, as an asset protection. That's our foundation of asset management, protects us against a catastrophic loss. Cash on hand gives us any kind of covers any current expenses that we might need to have covered. Savings plans are a broad-based, very very diverse kind of investment across a portfolio of mutual funds, and we're using dollar cost averaging over a long term to mitigate risk. On top of that, we might have a long-term position in a lump sum investment, right? We might buy a stock like Tesla, thinking that, okay, they're going to come out with less expensive Model 3 in the future, and they will have greater market penetration, and the price of their stock will rise, and I can make money. Then what we're going to look at, and as we see, risk continues to go up the further up this ladder we go, further up this building we go. Okay, so today we're going to take a look at real estate right here as an asset class. Okay, so the first misconception that we have to get over is the idea that owning your own home is an investment. It is not. If you are living in the property, it's your primary residence, it is a liability. It is not an asset. Okay? It can generate equity for you that you can, take out a loan and use it to accomplish some other investment. It can be a source of equity, but in and of itself, a primary residency is not an investment. It is not an asset. It is a liability. You're paying for your place to live. Now, if you let out a room, or you do Airbnb, or somehow you're able to transform part of the property into a money-generating revenue source, then okay, you can call it an investment. Now you might get some sort of return. Property investing means that we're buying a property, probably taking out a loan, with the intent of finding renters to produce a passive income. That's what a property investment looks like. So the key ideas, or the key features of a property investment we have to keep aware of. Number one, cost of entry. The cost of entry is very high. Even if you're getting 10%, if you're getting like 90% loan to value on a $100,000 home, it's still $10,000 to buy this home. And okay, let's say you can rent out this $100,000 home for $1,000 a month. Okay, that'd be great, because now you can make back your $10,000 deposit on your initial payment on your down payment. You can make that back in 10 months. Okay, wonderful. Thing is if you only have one home, you have a diversification problem. A Okay, diversity can be a problem with real estate investments. You have to have a number of homes before you're diversified, a number of homes across a number of different neighborhoods, or an apartment building, right? An apartment building, you're talking about millions of dollars for owning an apartment building, owning and running an apartment building. So it's we start to look at very high loan amounts, very high cost of entry, and very high leverage. Okay, so leverage is when the money that you have, that the money that you've used to purchase the property isn't your money. It's owned by the bank. Now you're making money in return, and so long as your income is greater than your debt repayment on a monthly basis, great. That's when debt can be good, when you have debt that's being paid back by the operation of your property investment. Now, that's where the risk lies. It's actually very high risk in terms of, what if you don't find renters? What if you need to decrease your rents? That's going to completely change your business plan. What if there is, a problem with the property that needs to be fixed? There's all sorts of repairs. There's all sorts of issues that can come up with being a landlord and needing to take care of your tenants, because you have a contractual obligation to provide them with a livable place. And if you can't afford to do that, you're going to have a problem. So not all of the money, you're going to have to take some of your income from your rental, from your properties, and leave it in a cash on hand fund available to take care of issues that might arise. Might need rewiring, might need to buy a new refrigerator, might need to do any number of things depending on what kind of market you're in. And from country to country, markets are different. The real estate market in Japan is way different than the real estate market in America. In America, you can trust to get equity, right? In Japan, you're losing equity every month. Then you have taxes. It's a different kind of tax you're going to have to pay on these too. It's a complex situation. It's not quite as easy as some people might make it out to be, or might think it might be. So real estate, sometimes we end up with a second home through inheritance. Sometimes we get some inexpensive properties through a dip in the market, like 2008. And that's the other thing to consider, that there seems to be an 18.5 year cycle to real estate, that values grow, and pop. So try to understand where you are in that cycle before you go buying an investment property. If you're buying a primary home, a primary residency, so long as you can make the payments, you shouldn't worry so much. If you're 1 or 2 years out from that cycle of property popping, property dropped in price, wait. Understand where you are, and understand where the market is. So it's pretty tricky finding good property deals to invest in. Anyway, that's just a little bit of an idea on real estate, why it's such a high risk asset class, more so than savings plans and lump sums, things like this. And we'll talk to you next time. Comment, like, subscribe, and make sure to reach out with any questions you might have. See you next time. Bye-bye.